Good evening, Steve. And I really want to thank you for making the time to have the discussion with us today about Let's Talk Valuation. And I know you very well because I was one of your students when I did my MBA, and we became friends. And I really appreciate the things that you taught me. And I think that a lot of dentists or physicians actually will learn a lot from understanding more valuation. But before we start dive into it, let me just introduce you. You're a famous
Sure.
guy. It's hard to shorten your bio quickly, but I did my best. So, Professor Carvell, you are a professor of finance in the Cornell's Johnson College of Business, and you have been a faculty since 1986. Congratulations on 38 years of doing it. So you have published numerous articles in academic and professional journals. You are a co-author of the In Shadows of Wall Street. Your work has been featured in the Wall Street Journal, New York Times, Forbes, and many, many more. You have recently finished a major project designed to identify the determinants of hotel demand for U.S. hotels and another on economic and capital market antecedents of venture capital commitments. Your private sector interests include consulting on valuation, and that's your strength, and risk analysis in feasibility studies, hotel debt, capacity, strategic benchmarking, and corporate and financial strategy. You serve on several private equity and startup boards in healthcare, real estate, hospitality, and consumer goods. Currently, you are academic director at the Center for Real Estate and Finance, Cornell Peter and Stephanie Norton School of Hotel Administration. So I think I summarized it as good as I can, but I think
Sure.
everybody get the message that you are the guy in finance and especially in valuation. So uh, since COVID, we've seen a huge trend in there were solo practitioners or group practices, but they were established in a certain age, they started looking to get out and to change their lifestyle and so on and so forth. Unfortunately, and we've discussed this in length in other podcasts, that's not part of your strength, is the reason is the and I had these discussions with you also. I mean, people are graduating right now with a lot of debt, are having a hard time committing on buying practices. So
Mm-hmm.
there's a lot of corporations as an entrant to the
Right.
industry, as it did with the medical. They are doing it in dentistry, and they are called DSOs. So back in the day, it used to be simple. You look at the reported taxes, income that reported in the taxes, and you average the 3 years, and you get between 60 to 80%, depending on your specialty of dentistry. With the entrance of DSOs, they started talking about EBITDA, and they multiply it by a certain number. That magical number varied depending. And and the funny part is, by learning from you, that multiplier has a way of discovering it, because it's a proportion between
Right.
the EBIT and the
The
value,
value.
or
Right.
the stocks. But we are not.
Yeah.
So
Yeah.
they're coming up with these empirical numbers,
Mm-hmm.
and I've heard numbers up to 12 if it's a big multiple practices and so on. But there's no norm. Like, you can't find anything, because once you told me you can search in your own industry, and I did a search because I listened to you. So I did a search, and it varied from 4 to 12, and nobody
Yeah.
told you what it is. So that's
Right.
why I wanted to talk to you, because it's very
Sure.
important point uh, in multiple facet. One of that is, in order for you to prepare for the EBITDA, a dentist needs to understand the basic stuff, which is the balance sheet. It starts with the balance sheet, and
Sure.
you've
Yeah.
always hammered us with it. So for a layman, none of us before I did that program understood balance sheet or have heard about balance sheet. I'll be honest with you. So why is it important to have a balance sheet for the buyer and for the seller to review?
Well, first of all, Edgar, thank you for having me on.
Right.
Thank you for the gracious introduction. Uh, and I will first quote Winston Churchill, who once said that such a small man can cast such a long shadow is nothing other than a testament to the lateness of the day.
Mm-hmm. It's a beautiful one. You're being poetic tonight.
So yeah. All right. So let me, because you mentioned a lot of things, but let me first just address the notion that when we go to value something, there'll be a book value of a company. And the book value of any company really is based on its assets minus its liabilities. So aside from wondering how much debt somebody might have accrued along the way, this is all in your balance sheet, right? Assets equal liability plus your equity, and you're trying to discover what the value of somebody's equity in their practices. And, which for a dental practice itself may or may not be indicative, right? I mean, in the old days, because that I'm a little older than you are, but back in the old days, my dentist had an old crinkly leather chair
Mhm.
and a little really worn out spit area, and the drills would come down on little tubes, and go back up a little bit. And the equipment was pretty, pretty basic, and I guess, you had, but in those days, he had his own real X-ray, and now that's all done with like more of a digital, environment. I don't have to tell you. So, for a dentist to practice, they still need those things. They're much fancier now,
Mhm.
but you'll have a room set up. And I think the reason why you described some variation in terms of valuation is I could imagine somebody like the guy I used to go to in the Bronx who had just one small room. And I don't even ever recall him having a receptionist. I think I just would go there and I would, that would be my time. And he would say hi to me. And we go in the little outer office and we would go into his little room there and he'd work on me. And you could think of that even with a receptionist versus somebody who has a larger area with, I don't know, 5. And then you have nowadays, of course, which is a big part of the practice in and of itself, you have people who do nothing other than cleaning,
Mhm.
and they do the x-ray work and they do this, you know what I
Mm.
mean? And now when I go into my dentist, he so far, like for the knock on wood, he hasn't had to do much. But the technician will do a lot of this work and he'll come in and like poke around for 2 minutes, maybe say hi to me, say something a little funny and walk out.
Mhm.
And so you can imagine that one practitioner and a couple of, licensed
Hygienist, yes. Mhm.
hygienists can do a lot of different things. And while he sometimes is even in another room and just takes a break for 2 seconds while somebody is in the middle of a procedure to come in and check on me and then go right back.
Mhm.
So the reason why I'm saying that is that yes, assets are important because they're the domain of how you can see people. And it's really about how those assets are deployed, right? And how new they are, right? And that's why, because assets depreciate, you buy equipment in
Mhm.
your dental office and it'll depreciate over time. And when you buy something, I'll just make it up. If you have $1 million setup that you just put in, it's now the day you put it in, of course, never mind, like I just drove the car off the lot or whatever, it's not really
Mhm.
worth $1 million anymore. But
Mhm.
every year it depreciates. Now the question is like, how current is it? How functional is it? Because the assets help you generate money.
Correct.
That's, or by money, I mean cash flow.
Mhm.
And that's really what it comes down to. The balance sheet of the business, aside from whether or not you acquired that, because that's none of your business. If you're going to buy somebody's practice and they have $1 million of assets, let's just say you give them $1 million.
Mhm.
You don't really care if they borrowed money. That's their business. They have to pay that money back. You don't really care where their money goes, if it goes to their father-in-law or,
Yeah.
wherever. You know what I mean?
Mhm.
So that's just that part of it. It's the assets, of course, are there, but in some areas and in some domains, you can imagine that those assets have the capacity, because of the type of clients you have and their wherewithal, to generate 2 or 3 times more revenue and cash flow than somewhere else. If you're in the east side of Manhattan, maybe you're able to generate 10 times as much cash flow as somebody who's in, Cleveland or Cincinnati, Ohio, or something, right?
Mhm.
So, the assets are the assets. They bought them from the same place you bought them from,
Mhm.
but they have different capability of generating cash flow.
Cash flow, yes.
And in the end, when we value something, because you're not just replicating the asset, you're really buying, when you buy somebody's business, you're buying what I would lovingly refer to as like their book, right? Who what their client base is, how much their clients spend, how old they are, the type of work they get done. You know what I mean? All that whole wide range of things that are associated with demographics, both income demographics, age demographics, that allow your assets to turn themselves into cash flow.
Yeah, no, it's but let me bring something to you, Steve, that
Sure.
when we buy our equipment, we depreciate them 100%. There's a clause that was passed at the time of
Oh
George
yeah,
Bush.
you're allowed to do that.
Yeah,
So you might as well
but
write it off as fast as you can.
correct. So you,
I
but
didn't mean the book
no,
value.
no,
I
but
just
yeah, yeah,
meant
but
the,
that's a very valid point. And in New York, for instance, New York City, they passed a law recently that they don't allow you can deduct federally 100%, but not New
right.
York City. So you have 5 years to do it. So on that perspective, but once you're buying, and the buyer is basically buying a goodwill, because the assets, as the equipment that you mentioned, is depreciated as zero value. So that's how it works. So you put everything in goodwill. So when you put it in goodwill, the buyer basically take over that tax liability, and then he starts depreciating goodwill moving forward.
Right, but the
With it.
goodwill is really is based, forget what you depreciated the
Mm,
assets on, Edgar,
mhm,
right?
mhm.
The goodwill is really how much I paid for the practice.
Correct.
So those assets may be worth nothing on the book. They may have an actual kind of like, functional value of $1
Mhm,
million
mhm.
or whatever. But if I'm paying $5 million for the business, whether or not 4 million goes into some asset base and the other is in goodwill, you're buying the cash flow stream. And
Yes.
that's why that difference, if it wasn't fully depreciated, the difference would go into goodwill.
Goodwill. Correct.
And ultimately the goodwill is just your way of disposing of that transactional value onto the buyer's balance sheet,
Yeah,
right?
Steve, since we're talking about that, I want to bring a point
Yeah.
that I recently, uh, came across with one of the last courses. But account receivables in dentistry,
Yeah.
it becomes it's a funny thing, because some people they do payments over time, but once you're purchasing that practice, basically you're purchasing that account receivable.
Yes, as well. Yes.
So that part of the asset cannot be given away for the for the seller. So we talked about that part of the balance sheet. That brings us to the
Well,
profit
let me
and
back up for a
yeah, yeah.
second because you mentioned accounts receivable, which is important.
Mm-hmm.
You know, and in some sense, if it's insurance money,
Mm-hmm.
you know, I don't, you know, you would know better than I would, Edgar, like how many months it takes to get the
The money.
insurance money,
Mm-hmm.
but it's coming.
Mm-hmm.
It's the same thing if you were doing business with the federal government, because I
Mm-hmm.
know some people who do that, you know,
Mm-hmm.
and they have government contracts, and boy, it takes 6 months, 9 months to get their money, but they know it's coming.
Mm-hmm.
And if you're constantly doing it as
Mm-hmm.
like a circular process, that money just comes in. And it's, you know, yeah, you know, it's time value of money, and you lose 9 months of, you know, carry charge, so to speak, on it, but it's coming. That's all. That's quite a bit different from somebody who has an insurance company and you give them some service, and the insurance company maybe pays for, you know, half or 60% or whatever it is, and then you have to bill them for the other 40% and wait.
Mm-hmm.
And that could take longer. So
Yeah,
because then also you have, as you well know, in those circumstances, uncollected money.
correct.
And that's why I meant that the demographics are important, because if you're buying a practice and the demographic shows that the people either are fully insured, they have great insurance, or they're always paying 100%, or you're buying the practice of somebody who half their people only pay 30% of the bill,
Yeah.
ultimately, those are two different practices.
Mm-hmm.
And I guess I'm slowly wrapping around to your point that the multiples,
Mm-hmm.
when an EBITDA multiple, and that's earnings before interest, taxes, depreciation, amortization, and that's
Mm-hmm.
just a proxy for cash flow,
Mm-hmm.
uh, can vary a lot. As you said, it might be even below 4, but it could be over 10.
Mm-hmm.
And the reason for that is that there is no real comparable. I mean, you know, right? Because those comparables are just what somebody's practice was earning
Mm-hmm.
and what they sold it for.
Mm-hmm.
And they may have had 2 or 3 little areas. They may have 10. So larger practices typically sell for larger multiples because they have more capacity to generate more cash flow over time and grow. But imagine if you're at capacity, you can't grow at all.
Mm-hmm.
So the multiple is also a function of how much growth possibility you have as a practice. And as I said, you know, how your, you know, what your demographic is. If your demographic, I don't want to, you know, we don't want to talk about it too much, but if your demographic is all people who are above 70 years old,
Mm-hmm.
yes, maybe you get one big shot there because you'll do some large scale implant, but then your work is done.
Mm-hmm. Yeah, 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 yeah.
Whereas if you have some people who are in their 40s and 50s, and they also have children, you have, you know, an entire stream of cash flow coming for many years for those people. So, you know, you have to, and because if you're looking at somebody who's older, you have to replace them in your system. And aside from word of mouth, then there's website marketing and so on, and that costs money. So what is the cost of an acquisition of a new patient? And all of those things are going to be factored into the range of those multiples going to, you know, lower single digits
Mm-hmm.
to low double digits,
Yeah, I see
you
what you're
know,
saying. Yes. Uh-huh.
and that's really where the trick is. And ultimately, you don't really want to buy the highest multiple because then there's not a lot of value add that you as the buyer can bring to the table.
Correct.
You know, you'd rather buy a practice that has a lot of untapped capacity
Mm-hmm.
and potential, because maybe you'll get that practice for 5 or 6 times multiple, but then because you're so much better at doing what you do, which of
Mm-hmm.
course you are, you know, that
Then there's a
all of a
potential.
sudden all of a sudden that 4 multiple will turn into an 8 or a 10 multiple. And you'll be the beneficiary of that, as opposed to paying at the top end, because if you're paying already at the top end, what's left?
Correct. That's a very good point. Thank you. But it comes back to the profit and loss also statements, because that's the mainly used in us. But I have to give you a little bit of a background in our business. There's two kinds. There's in medical, it's the same thing. It's either they are incorporated as an S corp or LLC, or they are sole proprietor. Very rare that you find any more sole proprietor, but let's assume they are S corporate or LLC. So they try to, and they are different. S and LLC are totally different, because one is pass it through to them. Both of them pass it through, but the LLC is easier, but the S is a little bit more complicated as a dividend. So let's say they minimize the amount of what's left over from the gain. So they put it in different things and stuff. And as you mentioned it, EBITDA, it stands for the earning before so then it becomes a game. How can we put back those monies that we've claimed here and there to increase that income? So that brings us to a very, very difficult thing in dentistry to really, or in the medical, to go over EBITDA. And you've always taught us that the cash flow is king. So, so let's talk about all of these, because they are all combined together and as a concept. And then, you like to evaluate differently. But let's talk about a little bit about that. And that difficulty in it for somebody like yourself is saying, look, you know what, I want to evaluate your practice, but that's the problem.
Well, let's back up, because you identify, I just wanted to clarify what we're talking about, what we would call the flow through. So, the revenue is revenue. That's pretty easy to know what revenue is, because there's not a lot of funny business unless you just, your client comes in with a
bag of cash. Yes. And that's a different story.
That's a different story. Yes.
But if you had debts, you have to pay them. So
so aside from that, the booking of the revenue happens straightforwardly. And what you're describing is like, how much other stuff did I load into the business, to kind of like cover, as you mentioned, there's people I know who own real estate, and, when they have fixed up their own personal home, because they have a whole bunch of other real estate, their builder says, oh, don't worry, when I replace that window, I'll say I replaced it over here. And that's not particularly tax-wise a legitimate thing to do, but people do it. And then, of course, what happens is the revenue turns into much less EBITDA.
Correct.
Now, of course, as they go to sell it, that becomes a problem, because they actually want you to pay them based on their real cash flow, not what they were able to siphon away. And this becomes then, I guess, a question of, first of all, I would say anyone out there who had a business and they were doing this over time, if they were thinking of selling, they should stop such funny business a couple of years before they're ready to sell it, right? Because, that's just a thing that creates an asymmetry of information. You're going to sit there and try to convince this new buyer that some of this money really was just, is really there for them, but it's not showing up on the book. But there are, again, if you go on, I was able to find, companies that publish, let's just say they're target flow-throughs, So what percent of your expense goes to doctor, compensation, staff compensation, dental supplies, lab costs? There are, let's just call it target averages of these things. And you should be able to see what a cleaner flow through would be from the revenue that would be booked. But again, like if somebody is playing around, that's bad on them, right? Because if their EBITDA is $1 million and they siphoned off $500,000, you might look at them and say, yeah, I'm very happy about that, but I'm only going to give you the multiple on the million,
On the million.
not the 1.5 million. Thank you very much.
Yeah, that's
and they
exactly.
may say to you, oh, and that of course may inhibit the transaction ultimately, because then the person will say, no, that's really not fair. And you understand how things are, you're in the business, and but anyway, so I think that's where that complexity comes in.
Yeah,
and again, for anyone listening, I would give them the advice that if they're ever thinking of, that they might want to transact their business, they should have a year or two of clean EBITDA to show.
Yeah. And that's exactly what I was hoping you give an advice, because this is a big problem for us in doing these things. So that brings us to the most important things, EBITDA versus net cash flow, where you can do your discounted.
Right. Yep.
And you, from knowing you prefer, and everybody who knows valuation, they would like to do the discounted cash flow, and they need to use a discounted rate. And that's important because that related to something you said it before, the EBITDA and how much there is potential, because any investor want to buy something, want to see a return every year over year over year.
Right.
And regardless if they paid you EBITDA or they pay it on a discounted flow, it's the same thing. This you make it cleaner. You expect them to do it like this. Sure. EBITDA, they still expect you to return every year that discounted rate. So I know what it is, the discounted rate, because I learned it from you. But a lot of people do not understand what's a discounted rate. So would you please start by this one first?
Well, I guess the way that we would think of it is that money has time value, and a business will. I mean, I know a dental practice is not like a potato chip manufacturing company, because it is more tied to the life of the dentist themselves.
Correct.
But let's say you as a practitioner have 10 or 20 more years of practicing today. That means you'll be generating 10 or 20 years more of income. And when you buy the practice, it means for the next 10 or 20 years, you'll be doing it. But cash flow that you make 10 years from now is not worth the same as cash flow that you make next year. So that's what we mean by discount rate. We discount down like it might be worth half as much or 40% as much once we do the calculation. And I know we're just on a podcast, so I'm not going to do the actual verbal calculation of it, but everyone should realize that I take a number that's 10 years out and I somehow have to figure out what it's worth today. And the thing that we do that with is a discount rate, which is just, how we take future dollars and make them smaller so that they can be added in today dollars together. Now, the simplest thing that happens now is whether or not we're looking at growing cash flows or just consistent cash flows. And if we're looking at just an infinite or quasi long-term base cash flow, we just divide by the discount rate. And that's what happens a lot. That's where the 5-time multiple or whatever comes in, because they use a 20% discount rate.
Correct.
So you would just say, if I have $1 million cash flow and I'm going to do that for the next 20 years, they would say, okay, if I did that, I'll take that and I'll divide that by 0.2, right? And then your $1 million becomes $5 million. And that's when we actually see the EBITDA multiple, that's kind of where it's coming from. It's not, I think you called it earlier like a magical number or something.
Yeah, it's not.
It's not really magical. It comes from dividing by a number. And you can imagine if the discount rate was 10%, that $1 million would have turned into $10 million, because then it's 1 million divided by 0.1. You know, in fact, what's really else is happening is that there's also some growing of the cash flow. So we just we add that growth rate. So it would be like another 5% or another 10% or whatever it is. But that's where those ranges come in, Edgar, also, is that there's a lot of growth that we have to, what we call, capitalize into the business when we buy it. Now, I should say, let's make sure the seller wants that number to be as high as it can get, and they'll be very rosy about the forecasts and very optimistic, but the buyer wants it to be as small as it could possibly be.
Yeah.
Because they're paying it out. You know, so, and it's, in a sense, when there's a transaction, first of all, both buyer and seller eventually have to meet at a number, or there's no transaction.
Yes.
And both of them realize it's a zero-sum game. If somebody's getting more money, the other person is paying more money. If somebody is getting less money, the other person is paying less money. And so typically, like, sellers will start out with a very high number, and buyers will start out with a very low number in that range. And they'll have to figure out where in that middle they can meet.
And just to explain to them too, that meaning when they make their calculation that they gave you $1 million, but that's, for me, it's like a $10 million. So every year I'm expecting that revenue that you're making has to increase every year more and more and more. Otherwise, why would I pay you that much? And there is a potential that the practice can do it or not. So
right, imagine if your practice was a ripening banana. You know, and the banana's gonna only last like 2 years. And at the end of the 2 years, it's, you know, there's nothing there to eat anymore. You know? Then why would you pay that? Let's say if you earn $1 million a year, but it's only for 2 years, that's, how much is that worth? And then it disappears. You're not going to pay $10 million for a million a year from now, and $1 million 2 years from now. So ultimately, it's all about trying to figure out the stream of cash flow you as the buyer can earn. And then you have to bring that all back into today dollars using that discount rate that you described. And then you try to figure out, okay, this is what it was earning when you were running it. Will I even make more than that? And that's why good operators can buy something and still make money. Otherwise, it would be like a zero-sum transaction. If you're as good as the other dentist and they get exactly what the thing is worth, there's nothing. You're just buying the practice, and there's no real gain for you.
correct. That is the point that I want to make sure that when people sell and they stay on board working for corporations or whatever, that they are expected to increase that rate every year. Otherwise, why would they even pay them?
And you and I have talked about this before, and that's why if you're buying a practice and you're asking the dentist to stay on for a period of years, usually what you do instead of, and I'll just make up the numbers, right, Edgar, just for simplicity, let's just say you think that practice might be worth $10 million. You don't pay the guy $10 million right off on day one. You say, you know what, I'm going to give you $8 million, and then I'm going to give you earnouts over the next 2 or 3 or 4 or 5 years to bring you up to all that money, because then you're kind of tying the person into the business. And they might, instead of earning 10 million, maybe if they do a great job, they might wind up in the end after 4 or 5 years with 12. Or they might end up with only 8. Or, you know, 9.
I mean, they will be part of the risk that has been taken.
Correct. And that's a more effective way to do it, because then the person is still really motivated to do good work. And also, when you mentioned before the word goodwill, especially in all kinds of medical practices. Again, honestly, there's two guys who work out front where I get my car done.
Yeah.
I don't think they do any of the work. They're just like a couple of old guys and they own the place, but they got a bunch of young mechanics working in the back. And you know what? I don't know who they are. I don't,
Hmm?
I just trust that these guys maybe are checking their work a little bit or whatever, you know what I
And
mean?
that is the
But
good
when
way.
you go into a doctor's office, the patients are used to seeing, Dr. Elchar, and they're comfortable with him because his hands have been, on them and worked on them, and they've seen what happens afterwards. And, and especially it's for their children or whatever else, right? You're handing over, a precious commodity, which is your
Hmm.
health,
Hmm.
into the hands of another human. It's not quite like my car. I drove my car and then like 4 days later, the sensor went back off and the guy goes, shoot. And I bring it back in and they reset it. And I'm like, okay, it's just my car.
Yeah. You're talking about their health. Yes, you're right.
Yes, it's
So
not the
that
same.
is,
So the goodwill that you're buying, and when somebody stays on and you do some kind of earn out, work with them, it also allows that transition to happen in a way that all the current patients
mhm,
will be very comfortable with and stay. You don't want to have them leave.
correct. So, Steve, we getting to the end.
Yeah, yeah.
Did I miss anything?
No,
Uh,
no, no. I think just that everyone should know that there's reasons why some practices exchange at lower multiples and others at higher multiples.
yeah.
And if you're a seller, you have to start positioning the growth characteristics of your business and understand what allows businesses, dental practices in this case, to grow. That's what I was saying. What's the demographic? How much more work are you doing? How do you sell to the clients to do better things and more things and have them recommend you and have new clients coming in? Are you always just aging out clients and have fewer clients coming in?
Mhm.
Or do you have a lot of new clients coming in? Because that's an indication of future
Yes,
growth. And
correct.
that's really what it's all about. It's about understanding the growth of a business and how that translates into value.
Perfect. Steve, as always, you are a man of wisdom, and I really appreciate that you made the time. I think many people who's going to listen will learn a lot and
Good.
understand better because I think we simplified it to a great deal. And
I hope so. I hope
yeah,
so, Edgar. And I'm blessed to have had you as a student in the class, and
thank
now to
you.
become a friend together.
And
And I will also just say, because I like to be spiritual with
yeah,
everybody. I like everyone to know that you remember this one, right? There's only one thing that exists that when you give it away, you
yeah,
have more of.
yeah, you're right.
And
Absolutely.
that's love.
Yeah. Yeah.
I just really just want to say how much I appreciate you, Edgar,
Thank
and
you.
have a wonderful evening.
Thank you, you too. And I really appreciate it, Steve.
My pleasure.
Thanks.
My pleasure. We'll talk soon.
My best to everybody. Bye bye.
Yeah, yeah. Bye bye.